Merger of equals is a all-stock acquisition transaction, usually between two companies of similar or the same size. Merger of equals have various social considerations in addition to financial considerations, usually a split board, split management teams. On the financial side, a traditional merger of equals has a very low or no market premium, and the value is really based on the performance of the combined company. Merger of equals have become rather controversial and have a mixed history. If you were to Google the phrase, "there's no such thing as a merger of equals," you would get over 1 million hits. So the consensus is no, there's not really a merger of equals, but that's not that important. A lot of the problem is with the word equal. You take out equal, and a merger is simply a stock-for-stock transaction where the selling company will own a significant portion of the acquiring company after the transaction. In point of fact, it's important to remember that many of the highest return banks in the country have had at least one transaction that was described as a merger of equals or a strategic acquisition, strategic merger in their history. So it can be a very effective transaction. It just leads to a lot of confusion and some shareholder skepticism because it's difficult for anything to be equal. Mergers of equals are stock-for-stock exchanges, and the most important part of the negotiation will be the exchange ratio. And the exchange ratio should be based on the financial contributions of both sides, including cost savings, to the pro forma. And in order for there to be strong shareholder acceptance of an MOE, the exchange ratio has to be shown to work for both sides of shareholders. The exchange ratio many times is not the most difficult part of the negotiation. The most difficult part can be the non-financial considerations such as management and board representation. In a merger of equals, the transaction can work for both sides as long as the exchange ratio is fair and carefully considered and negotiated up front. Because the upfront premium is usually not that significant, it's somewhat easier to earn back the premium so that earnings per share and tangible book value increase for both sides. Again, it's important to remember that many high-return banks have executed at least one deal described as a merger of equals in their past. For instance, the Wells Fargo and Norwest transaction is considered one of the most successful bank deals ever, and that was described as a merger of equals. So it is definitely possible to structure something that works for both sets of shareholders. So much of the skepticism about merger of equals comes from the seller shareholders. And most studies have shown in M&A the selling shareholders end up better than the buying shareholders because they get the premium. So the consideration is for the selling shareholders, if we're not getting a premium, then we're giving up what's traditionally the most beneficial part of a transaction. Why would we do that? And in point of fact, there are many reasons, mostly linked to what are the other options that the seller has. But overcoming that initial skepticism on part of the selling shareholders will be the most important consideration.